Welcome to Perspective Lab, where we break down complex topics, so you can understand what's really happening around you. Before we dive in, don't forget to like, subscribe, and hit the bell icon. That way, you'll never miss an explanation that cuts through the noise. Today, we're tackling a big question: why does the US economy feel broken, even when the numbers say it's fine? The US economy, according to official data, is doing fine. Inflation is down from its peak. Unemployment remains low. Corporate profits are strong. And yet, millions of Americans feel like they are falling behind. Rent feels unaffordable. Groceries feel expensive. Savings feel impossible. So today's question is simple, but uncomfortable. If the economy is strong, why does it feel so broken to so many people? The answer isn't political. It isn't emotional. It's structural, and it explains a growing disconnect between economic headlines and everyday life. Let's start with what the data actually shows. According to official US statistics, inflation has slowed significantly since its peak in 2022. Unemployment remains near historic lows. GDP growth has stayed positive. On paper, this suggests a resilient economy. And technically, that's true. These indicators measure production, employment, and price changes across the entire economy. But here's the problem. These numbers don't measure how life feels. They measure averages, not pressure. Economic averages can be misleading. When inflation slows, it doesn't mean prices go back down. It means they stop rising as fast. A gallon of milk that doubled in price doesn't become affordable just because it stopped getting more expensive. For households already stretched thin, that distinction matters. The economy may stabilize, but personal finances lag behind. Wages are another key part of the story. Yes, wages have risen in recent years. But for many workers, they haven't risen enough to offset higher living costs. Housing, healthcare, education, and insurance have all grown faster than wages over time. This creates a silent squeeze. People are technically earning more, but functionally affording less. Housing is where the disconnect becomes impossible to ignore. Home prices surged during the pandemic. Mortgage rates then doubled in a short period of time. For new buyers, monthly payments exploded. For renters, limited supply pushed rents higher. Housing costs don't just affect where you live, they affect everything else you can afford. When housing consumes more income, financial flexibility disappears. Higher interest rates were designed to slow inflation. And they worked, partially. But interest rates don't hit the economy evenly or instantly. Large corporations locked in cheap debt years ago. Wealthy households carry less variable rate debt. Meanwhile, middle and lower income households feel the impact first, through credit cards, auto loans, and rent. The pain arrives before the relief. Another reason the economy looks strong is corporate profitability. Many large companies increased prices faster than costs. That protected margins and shareholders. But higher prices don't feel like growth to consumers. They feel like pressure. An economy can generate profits while households struggle. Both things can be true at the same time. Household debt plays a major role in this disconnect. Credit card balances are rising. Interest rates on that debt are near record highs. Debt turns short-term price shocks into long-term financial stress. Even if inflation cools, debt payments remain. And for many households, they are growing. Economic recoveries are rarely shared equally. Asset owners recover first. Wage earners recover later. If you own stocks or property, rising asset values soften inflation. If you rely on a paycheck, rising prices hit immediately, and recovery feels delayed. Consumer confidence isn't irrational. People judge the economy based on personal experience, not government reports. When everyday expenses rise faster than income, trust erodes. This is why economic sentiment can stay negative even when data improves. The recovery hasn't reached daily life yet. Headlines often focus on markets, growth, and indicators. But people live in monthly budgets, not charts. When coverage celebrates strong numbers without context, it creates frustration, not reassurance. Understanding the economy requires translating data into lived experience. That translation is often missing. The key takeaway is this: the economy isn't fake strong. And people aren't imagining hardship. They are responding to different layers of the same system. Macroeconomic stability doesn't instantly repair household balance sheets. That takes time and policy choices. When people say the economy feels broken, they aren't rejecting the data. They're describing the gap between statistics and reality. Understanding that gap is essential, not just for policymakers, but for anyone trying to make sense of the world around them. If you found this helpful, don't forget to like, subscribe, and share. Your support helps us make more clear, unbiased explanations every week. Thanks for watching Perspective Lab. See you in the next video.